up we have Outlook 2025 with the Reserve Bank of New Zealand Deputy Governor Christian Hawkesby, which will be followed by a fireside chat with New Zealand Herald Business Editor-at-Large Liam Dann, which will delve a bit further into the issues that come up. Please remember to submit any questions that you have via the app during the session. But first we'll just introduce our two speakers. Christian Hawkesby has been with the Reserve Bank of New Zealand since 2019. Prior to his appointment as Deputy Governor, General Manager Financial Stability, Christian was the Assistant Governor and General Manager of Economics, Financial Markets and Banking. Christian was also part of the team that established Harbour Asset Management, which was awarded Morningstar New Zealand Fund Manager of the Year in 2014, 2016 and 2017. Before this, Christian spent 9 years at the Bank of England, where he held senior positions including Private Secretary to the Deputy Governor, Chief Manager of Sterling Markets and Head of Market Intelligence. And Christian graduated from the University of Canterbury with a Master of Commerce honours majoring in economics.
And our facilitator is Liam Dann. Liam is one of New Zealand's most experienced and well-respected business journalists. He was the Herald's business editor for 8 years before moving to a more expansive role as business editor-at-large in 2016. He now writes opinion and commentary covering markets, economics and politics. He is also the host of the podcast Money Talks and video show Market Watch. First, let's welcome Christian to the stage.
Ina mana, ina reo, ina karanga, maha o toa, tēnā koutou katoa, morena koutou. G'day, and it's a delight to be here this morning at my first ever Financial Services Council. So when I was appointed into this role at the beginning of the year, the phone literally rang straight away, and it was Richard Clippen inviting me to here to talk today. So I've had 9 months to think about what I'm going to say. So no excuses, despite the fact that my alarm clock didn't go off this morning and the fact that my taxi didn't arrive to take me to the airport. I did make it here and I didn't get stuck in traffic, thankfully, either. So what I've been reflecting on actually is just how much the financial services industry has changed over the course of the 25 years that I've been involved in the industry, first as a central banker, then as a fund manager, and now most recently this year as a regulator. And I'm sure also if you also think and reflect how much your role in the financial industry has changed, how much the financial services industry has changed around you. Your clients, the needs of your clients, the products that you provide, the competitive landscape, the expectations on you as financial services providers. So when I think about when I started in the industry back in the Reserve Bank as a young graduate in the late 1990s, the Reserve Bank was famous for two things. One of them was being the first central bank in the world to have a formal inflation targeting regime for monetary policy, and we sort of remain famous for that. The second was our light touch banking supervision approach. So it was an approach that was very much reliant on market disclosure, market discipline, buyer beware, effectively. And if you'd asked our international colleagues, they would have said the Reserve Bank doesn't really do banking supervision, and they would have said that New Zealand is, pretty much the Wild West when it comes to financial regulation. So roll the clock, forward to where we are now, 2022. There's obviously been a lot of water under the bridge, many lessons learnt. We've been through the global financial crisis. There have been financial failures, and there have been regulatory failures too through that time, most notably CBL insurance. I mean, through that time, there's also being a growing appreciation of the importance of the financial services industry to society as a whole. what an important role we all play in the prosperity and well-being of the entire country, the social cohesion of the country. And there have been growing, as part of that, there have been growing expectations on us as a prudential regulator. So expectations on us to regulate and supervise more than the banking industry, but non-bank deposit takers, credit unions, building societies, life insurers, non-life insurers. Expectations on us to use more than market discipline, to apply regulatory discipline, supervisory discipline, and to have all the tools that you actually need as a modern prudential regulator and supervisor. Expectations on us to care more than just about having a stable financial system, but to have a vibrant one, to have one that involves a focus on financial inclusion, financial innovation, and all of those things that ultimately matter for well-being. Expectations on us to work really closely with other regulators and collaborate, particularly with the Council of Financial Regulators and the Financial Markets Authority. Expectations on us to take a long-term perspective, to think about things like climate change and work with the industry to manage those challenges. Expectations on us to draw on the wisdom of Te Ao Māori and what that can provide to us and what it is to be uniquely a New Zealand central bank and regulator. And then finally, expectations on us to earn our social licence. So to be accountable, to be transparent, and to be able to tell the story of what we do more than just to a narrow group of academics and chief economists, but to broader society as a whole, and to speak in a language that people understand. So that's how the environment has changed for us, and all of those things have really come together into this idea of the Reserve Bank as the kaitiaki of the financial system. So part of the financial services industry, standing shoulder to shoulder with you as part of it, but also the guardian or caretaker with a long-term perspective. So over the last few years, we've been going through probably the biggest legislative reform in 30 years at the Reserve Bank, and it's really been a story of just catching up with those expectations on us. So in July this year, the Reserve Bank Act 2021 came into force, and within the Act we have a new purpose, an overarching purpose of promoting the prosperity and well-being and contributing to a sustainable and productive economy. Previously we didn't have that overarching purpose that really told that story of why it is that we do everything that we do. We have a new financial stability objective of promoting a sound and stable financial system, and so that stands shoulder to shoulder with our monetary policy objective of price stability and contributing to maximum sustainable employment. We have a new financial policy remit, which instructs us to seek our objective of a stable financial system, but do it in a way that we have regard to financial inclusion, financial innovation, the costs that are imposed from regulation, and taking a proportionate, risk-based, outcomes-based approach. We have as part of the Act, we have a new fully empowered corporate board to make financial stability decisions, standing shoulder to shoulder with our Monetary Policy Committee. And in the new Act, it provides a legislative role for the Council of Financial Regulators, so it gives it that elevation and really promotes us to collaborate with other regulators and with the industry. So that's what's been going on in terms of our legislative backdrop. That has been going on in parallel with changes to the Deposit Takers Act, the Insurance Prudential Supervision Act, and the Financial Market Infrastructure Act, which really just have all been reviewed, revised, refreshed to give us those modern tools to act as a modern regulator. So we've got a really big agenda in front of us, a lot of mahi ahead of us, and I guess my key message to you this morning is that it's something that we know we need to do together with the industry. We want to work with you to build the relationships that we need, to build them beyond that narrow, banking industry, which is where we started out. We need to work with you to help identify the risks and identify the opportunities for New Zealand's financial industry. And we need to work with you to prioritise the work that we have ahead. We need to work with you to continue to evolve, to meet the expectations of society for the financial services industry as they evolve too through time, and I'm sure that they will. And I know that we all do want to work together on all of these things, because ultimately, in the long run, we do share the same objective, the same purpose. We get out of bed for the same reason each morning to come into work, and that is to do our mahi to contribute to the prosperity and well-being of New Zealanders, and to promote a sustainable and productive economy and society that we all live in. So, nō reira, nau te roro, naka te roro, kai ora ai te iwi. With your contribution and our contribution, the people will prosper. Tēnā koutou katoa. Thank you.
Look, thanks for that. And just to say, I'm going to start with a few of the tough questions out there. We're not able to take questions from the floor because we're on a tight schedule, but I'm going to challenge Christian on a few things here, and then get into a bit of debate about where we are in the economy and where we're going. So, Christian, I think you make a really good case, and certainly paint a vivid picture of how the bank has evolved, how it's broadened, how it's sort of embraced wider challenges. I guess one of the issues right now is that there's a lot of debate, perhaps because inflation is back, about whether the bank is then distracted by that. And what do you say to those who feel that the bank ought to have retained that absolute singular focus on monetary policy and targeting inflation?
Yeah, well, I think I'd say a few things. One is that the bank's mandate, the bank's remit has broadened over those 25 years, as I told that story. But also our resources and the size of the bank has changed. We're 2 or 3 times bigger than we were back in the late 1990s, to sort of reflect that broader scope, the more work that we need to do, the broader perspective. I mean, to those critics who say, we should have a narrower focus, I'd say 2 things. One is to look at overseas practice, and that's something that we sometimes forget to do in New Zealand. We're focused on our little islands and what happens here. Take something like the Network for Greening the Financial System, the NGFS. It's a group formed 5 years ago by 8 central banks and regulators to focus on greening the financial system. Less than 5 years later, there is now 110 members of that group. This is core central banking, this is core regulation, this is what goes on internationally. I'd also say that, those expectations that I talked about, they come from the industry.
Yeah.
So the industry wants the Reserve Bank to be involved in these things like climate change. They want the Reserve Bank to be able to provide guidance they understand that the risks are large and they are focused on those risks. They're looking to the Reserve Bank for guidance. They're looking to the Reserve Bank for clear regulation. They're looking to us for, working on stress testing and all of these things that we need to do. They're looking to us to be in the room with government, local government, and other parties that are part of the conversation. So I think that's what's driving the changes.
Sure. I mean, and look, it's a live organisation. There's always going to be debate, political debate about how it operates and its mandate and so forth. But it does seem that it's been particularly intense, and I guess we've all, debate generally has got very intense since the pandemic. But I wanted to ask, because of the I guess some of the criticism in the media and all that sort of stuff, how the morale is at the bank right now, and do you guys feel embattled, or is it business as usual for you guys?
Well, I think one of the things when you join the Reserve Bank, you know that it's an organisation that a lot of people are passionate about, and they're passionate about it because the Reserve Bank has an important role to play, and we have an important purpose, and we have a lot of powerful tools that we can draw on, so we need to have that accountability, responsibility, transparency about what we do. Do we feel embattled? I'd say, I'd rather be at the Reserve Bank than being the coach of the All Blacks over the course of July and August. I think the people that come to the Reserve Bank, the morale is good. And why is that? It's because of that really clear purpose and sense that you come into work every day and you're doing work that matters. Yeah, I mean, there's certainly a lot of reflection about inflation right now, and I see central banks around the world copping a lot of blame for inflation now. I guess that's around the stimulus that was done during the pandemic. Do you think that's fair? And with hindsight, do you feel that the RBNZ did overstimulate the economy? Yes, it's a very common story globally, and so when we talk to our colleagues in the central banking world, you pretty much get the same story across the piece. If you look across the OECD, average inflation at the moment is 10%. In New Zealand, it's 7.3 as the latest outturn, and there's that same story about inflation coming from energy, food prices and construction. It's a very similar story globally. Again, it's useful to look overseas for those comparisons. And also the story about how we got there is incredibly similar when we listen to colleagues from overseas. It's about the demand side of economies being so much more resilient and robust than we feared when COVID struck. At the same time, the supply side of the economies have been so much more impacted, affected, disrupted for so much longer than we expected at the beginning of the COVID pandemic. So those two things come together, they get you a higher inflation environment. But we would, stand by the actions that we took through the course of 2020, 2021. It was in an environment where uncertainty was so extreme that central banks globally had said, look, we're not really in the business anymore of having central forecasts and projections. We're in a world of dealing with scenarios. We need to avoid the really bad, painful, nasty scenarios. The bank talked about, at the time, right from the beginning actually, the Governor talking about the path of least regrets. Do you still feel very much that you're on the right side of that path? Well, so we've talked about least regrets, and it's really just a language that we've used to describe a risk management approach. And it's very typical within central banking when the uncertainty is very wide. You just need to take a risk management approach. And so our least regret when COVID struck was to do too much too soon rather than do too little too late. And what are the scenarios? We could be in a scenario where unemployment was really high, the economy was in a big hole, and we were facing deflation in a period where we'd been battling to get inflation up to our midpoint of our target for 10 years. Do we want to be in that scenario, or do we want to be in this other scenario where inflation's running a bit hot and we're having to do some things to bring it back down again. That sort of least regret approach, we need to keep revising that through time. So, at the moment, our least regret is to do what's required to ensure that inflation expectations remain anchored at our target, and that we have that credibility that people genuinely believe that that's the outcomes that we're going to generate going forward.
Sure. So last question, looking back, because I think the finance minister responded to some of the critics with the idea of that 2020 hindsight. But we all learn, and we hadn't had a pandemic like this before. How the economy behaved, The opposition, National Party and ACT, I guess, have called for an independent inquiry into how the stimulus unfolded. What's your response to that, and what is the Reserve Bank looking at in terms of learning from the experience?
Sure. Yeah. So first thing is it's not our role to announce an independent inquiry or appoint one. That's a role for others. What we're doing and what we have a responsibility for under our legislation is every 5 years we have to review the monetary policy remit and say, well, given what we've learnt, is it still fit for purpose? Are we still aiming for the right things? And every 5 years we need to do a backward-looking review of what was our performance over that period. What did we, what lessons have we learnt? And it's a really good exercise to go through, and you've kind of got to go through it, thinking about, well, what did we know at the time? Given what we knew at the time, what would we have done differently, or what can we learn from that experience? Because when you look back over history, you look at the crises that we've been through internationally over the last 20 years, the response to the dot-com bubble, central banks left stimulus in for too long, and that created a bubble going ahead. After the GFC, central banks took away the stimulus too quickly, was the main lesson. And then now, post-COVID, the question is, did we leave it in too long? The conditions will change through time, and to say that we keep conditions too loose for too long, is that going to help the next crew that come along later? So the lessons we have to really look at is, well, given what we knew at the time, and reflecting back, there are, some lessons around us as a central bank being, very focused on the demand side of the economy, the cyclical side of the economy. When it came to COVID, it really required a deep understanding of the supply side of the economy, understanding a lot of the other government policies that were in play. And when people think about, well, what are the lessons of the COVID experience, one of the things you quickly come to is, well, looking at monetary policy in isolation is very partial. We need to look at what the lessons were from the fiscal response, the monetary response, the health response, the immigration response. All of those things,
Sure.
Come together.
To look at it right now, and I know there's some things you can't give away in your role, but the two big questions I always get asked about economics are, one, where are interest rates going? And I won't ask you that one exactly, or how worried should we be is the other one. And when you look at the inflation fight right now, what do you see as the biggest risks out there to sort of, I guess, getting to a soft landing, which is what we're hoping for?
Yeah, I think we are laser focused on what our mandate is, and it's about achieving price stability and supporting maximum sustainable employment. So that's always the prism that we look at things through. Inflation, obviously, from around May last year, we were talking about the risks to inflation being to the upside. And some of as we saw the demand side of the economy being more resilient, and as we saw the supply side being more disruptive, we've been talking about the risks to inflation being to the upside. Where we, and in response to that, that's where the tightening of conditions came in, and we're now in an environment where monetary conditions are significantly tighter than they were 12 months ago, partly based on the signals that we've provided and the impact that that's had on things like mortgage interest rates and other interest rates. So we're getting to a point now where the outlook for inflation is becoming more balanced, and actually, we've got growing confidence that over the course of the next 12, 18 months, inflation is going to be significantly lower than it is at the moment, for a number of reasons. Internationally, what we're seeing in the oil market, energy prices, the way that they've turned around, the way that the supply side disruption is starting to unwind. You look at shipping costs, freight costs, all of these things, they are elevated, but they're much lower than they were. And also you look at the actions that foreign central banks are taking. A little bit slower off the mark than us, but they're moving in fast clip now, and that will tighten, that will constrain global demand. All of these things sort of coming together.
There's this weird sort of upside down sort of scenario you get to where, and I'll come to the GDP figures last week, which surprised the market. I don't think they surprised you. You guys were pretty close on your forecast, 1.7 versus 1.8, but for the quarter. But it's the feeling suddenly comes through from the economists. Oh, the economy's too strong. So now we're worried about extra inflationary impact, interest rates going higher. What do you make of this sort of weird idea that we're sort of cheering for a downturn? Is good news bad news now? How do we read that?
Yeah, I guess our key message, and it's sort of, is that the level of demand is running above the capacity of the economy to supply and to meet that demand. We have capacity pressures coming through. Everyone's got their anecdotes about the labour market, how tight the labour market is, how hard it is to find resources to meet that demand. That's what's got us into that position that inflation pressures are too strong. And so where do we need to get to? We need to get to a place where demand cools off and supply lifts up to meet that more cooled demand. That's what's been motivating us to increase interest rates. And the projections that we put out back in August, it does tell a story of very subdued consumption growth over the period ahead, and that's part of how we get back to where we kind of need to get back to eventually.
I mean, when we look at the GDP data that came out, it was good, but there's obviously a lot of different components. What parts of it were heartening for you, and what parts of it were like, oh gee, that maybe is running a bit hotter than we'd like?
Yeah, I guess the other point to make is it's still very hard to get a read on the economy from individual bits of economic data. I mean, you just think about, these things are quarterly summary measures in an environment where we've been going in and out of lockdown, large swathes of the labour market have been going in and out of isolation, and it really just, that creates a huge amount of volatility month to month, quarter to quarter. What we did see in that GDP number is some cooling in, consumption, and that's something that we would expect to see going forward. Probably more of a 2023 story when you think about how long it takes for a tightening in monetary conditions to work its way through the financial system, work its way through to mortgage holders rolling off low interest rates into where they've got to now. Sure.
So I wanted to, we've talked a lot about monetary policy, but step back, and they are interrelated, and look at financial stability. And I guess it's about the economy's ability to handle a downturn over the coming year or two. When you look at the current balance of debt and savings in this country, what do you see? What worries you about it, or what's heartening about it?
Yeah, so I guess from that perspective, we're always looking at building resilience into the financial system. We look at what risks there are out there, what things can disrupt the financial system, can disrupt the economy, and we think about how resilient the financial system is to those risks and shocks. And that's been a big part of what we've been doing in terms of lifting the capital requirements for the banking system, making sure there's strong liquidity buffers, the work that we've been doing on macroprudential tools with loan-to-value restrictions and all of those things to sort of strengthen the asset quality of the financial system. So that's the way that we look at it, the kind of resilience that we're looking to build in. We also look more broadly at what's going on, more broadly within the financial services industry, and the savings that there are there in households through COVID. The household savings lifted. There was a lot more that created a lot more resilience and a lot more ability for consumers to keep consumption up through that period. We look at the maturity of our financial services industry, the products that are available, the growth of the savings industry, and we see how that can continue to build resilience into the system.
So I guess just to wrap up, really, and as a sort of a message for this audience, that savings component is key to sort of balancing the ledger for New Zealand when we look at risk, right?
Oh, absolutely. Our Achilles heel through time has been high household debt. But you need to think about it in terms of, on a net basis. We do have a highly indebted household sector, but to the extent that they can also keep growing their savings, keep growing their assets, that does build the resilience in there that we need.
Look, that's great. The screen is telling me time is up. So thank you, Christian, very much. Cheers.
Thank you, Liam and Christian, for that discussion. And it was really heartening to hear you say, Christian, that inflation might be significantly lower over the next 12 to 18 months. I was like, yes, there's hope on the horizon.